Well, we've been talking about rates in the US and how perhaps the Fed has kicked off a global easing cycle. Let's bring it down to India and get a perspective on, what we should expect on rates here in India, and of course what the impact on financials really is. Remember, the neutral rate in India is estimated to be between 1.5% to 2% odd. RBI's target inflation is 4%, and RBI is not expected to start to cut rates. Is expected to start to cut rates only by about December of this year, maybe a few 25 basis points from that point on. We have the former RBI Deputy Governor, Mr. S.S. Mundra, is joining us. We have Param Subramanian, Vice President, Equity Research, Banks and Financials. He's with Nomura. Gentlemen, great to have both of you here. Thank you very much for your time. Mr. Mundra, if I can start with you. The Fed's cut, when do we start to see the cut here in India? And in your experience, is this a big global easing cycle on the downside? How does it typically play out? Go
on. Thanks for having me here. If I look at it, actually, 50 basis point cut has come as a surprise, little bit of surprise. But if we look at the US scenario, I think all the forecasters were expecting a 25 basis point cut. But market were already probably building in a 50 basis point cut. That was the scenario before the Fed meeting. Now, with this 50 basis point cut, probably what Fed is signaling that maybe they are comfortable with the trajectory of inflation. They are also factoring in the fact that while inflation is at 2.5%, but there would be lag impact, and it will be on course. And probably focus is on now employment and growth. Interestingly, the expectation, the forecast of a recession in the US has significantly increased in last 1 month. I think from almost 50% to 61%, and that is the trigger. But there is an interesting point between the India and the US. While in India, the consumer inflation is well on lower trajectory, but the core inflation is stubborn. In India, the situation is exactly reverse. The consumer inflation is stubborn, while the core inflation, in fact, part of it has even moved into the deflationary category. Anyway, my view is, or I would say, expectation would be, desire would be that probably RBI now would move with a 25 basis point cut in its next policy announcement. There had already been a significant divergence of view in the MPC. Of course, we would have a new MPC, new members, but I would expect that this 25 basis point cut, where the RBI would also factor in that there will be some lag impact. If you read the inflation reading in the nearest month, that is the July and August, it is already below 4%. Of course, RBI will take a longer view, would like to look how the trajectory is in next 6 to 12 months. But I think looking to the overall environment, looking to the Fed action, and looking to the data point which is emerging within India, also slowdown in both consumer-facing activities as well as the investment-facing activities.
Right.
There is a sign of some slowdown. Probably a 25 basis point cut would be a thing to go for.
Okay, got it. Thanks for sort of putting it clearly, Mr. Mundra. Param, if I can come to you. Good morning, Prashant here. What's the impact on financials here in India? If you can go segment by segment. Sure. Are there any plays here from a stock perspective? Go on.
Yeah, sure. Thanks, Prashant. Good morning to all your viewers. So yes, from a rate cutting perspective, if you look at it for the banks from a margin perspective, remember in this cycle, it's different from previous rate cutting cycles because banks have a large portion of their loan books directly exposed to external benchmarks, and so when the rate cuts do happen, there is a negative pressure that will come through on bank margins as well as their ROAs. The rough math we have is that about a 50 basis point rate cut by the RBI will translate to about a 15 to 20 basis point negative impact for the large private bank margins. At an ROA level, it probably comes down to something like 7 to 10 basis points, right? Some of the smaller banks, mid-cap banks that have higher fixed rate exposures, they have a lower, say, negative impact on their margins and their ROAs. But you also have to take into account the fact that some of these smaller banks also have, exposure to riskier segments, be it microfinance, be it personal loans that have been in focus from, say, an NPA perspective for the sector as a whole. Now, that's the first order impact. From a second order perspective, you also have to take into account that, rate cuts generally do bring in easier liquidity, and that has been one of the constraints for the sector as a whole. So when you have, say, an easing money supply, that will also help the the banking sector from a growth perspective as well. And generally, in 2 out of the 3 last rate cutting cycles, we've actually seen CASA ratios for the sector as a whole also improve. Now we've seen sharp deterioration in the CASA profiles across the banks over the last 2 years. But at the margin, if you are moving into an accommodative phase, one would expect that you don't need to be very negative on this front. From a positioning perspective, we are more towards the large private banks at this stage. So the names we like are names like Kotak Bank, ICICI, among the large privates. We also like SBI among the PSUs, and within the mid caps we like a federal bank. We don't see a need to move down the risk curve. Of course, there is a margin level pressure, but to play that, we don't see a need to move down the risk curve as the sector as a whole is pretty cheap, from a historical valuation standpoint.
Well, Param, quickly, do NBFCs, because the liability side has been the problem for a lot of NBFCs, liquidity has been tight, larger ones can raise, go overseas, etc., smaller guys cannot. Do you think, from an investor perspective, NBFCs and some of the smaller ones stand to benefit as well?
Yes, of course. So the NBFCs are natural beneficiaries. And the way we would look at it is to look at NBFCs that don't have problems, at least from a credit cost or NPA formation perspective. And from that standpoint, we are more in favor of some of the secured NBFCs, which will have the the margin benefit tailwind as well as the liquidity easing tailwind, but not as much of the credit cost pressure. And from that perspective, the names we like are names like Shriram Finance. Within the affordable housing space, Aadhar Housing is something our analyst likes. And we also like a small SME focused lender called 5-Star. So I think that's the way to look at it. Secured NBFCs is of course a key beneficiary. Yeah.
Okay, got that, Param. I'll stay on some more questions in a bit. Mr. Mundra, if I could come back to you, sir. You said that in all probability, maybe we'll see 25 basis points from the Reserve Bank of India. But let me ask a wider, broader question. Apart from the fact that, one of the biggest central banks in the world is now on a cutting cycle, does the RBI really have any reason to move on rates at all? Because inflation, consumer inflation, like you rightly pointed out, sir, is very, very sticky. And the governor has been always in his commentary mentioning that there's a hawk eye on inflation and we can't sort of, lift the foot off the pedal there. And on the other side, growth is not really faltering in India. So is there a need to move on rates at all? The RBI could perhaps look at liquidity measures instead of rates, could it not?
No, you are very right. And probably that is why I say my desire would be, I never said that RBI would cut. That was not an emphatic statement. I said my desire would be that there should be a cut. No, the point is, as I mentioned, in the recent month, the inflation reading is below 4%, while growth is strong. But if you again look from the recent month, both on the consumer-facing business as well as the investment-facing businesses, there had been a slowdown. So I think while growth is continue to be good, but it continue to remain below potential. So I think that is where the tipping point is, and that is why I said that probably now there is a room, because if with US 50 basis point cut and India remaining where it is, I think the RBI would have to face another problem, is a tricky part. And that would be probably the inflows coming, rupee appreciating, which can create problem for the export sector which had already seen, some discomfort in the recent months. So I think this is where the, balancing factor is there. And that is why I said probably RBI and within MPC also, there is a divergence of view now for quite some time. So maybe probably this time RBI may prefer to start a cycle or at least giving a signal. Of course, it could be either a rate cut or it could be, as you rightly said, there could be liquidity measures, there could be some other indication or even the stance may change. But some action would certainly emerge. This 50 basis point cut by Fed cannot be completely go unnoticed in the RBI's policy announcement. That is my point.
That's a fair point. Thank you so much for laying down the thought process of the RBI, what your desire is and what the expectations are from the street as well. Mr. Mundra, Param also talking about the stocks that you like and the sector which is little, still has some value on offer as well. Insightful discussion this. What we'll do is